Something just changed in the silver market. Not a price move, not a rally, not a crash, a regime change, and almost nobody is talking about it. Because for decades, the price of silver was decided in one place. Not in mines, not in factories, not in government vaults, but in paper markets, futures exchanges, derivative contracts, speculative positions, a digital battlefield where traders moved billions of ounces with the click of a mouse. But now, that era may be ending. A quiet statement from Vice President J.D. Vance about a possible metal-backed policy, and an even quieter announcement from the State Department. I've just signaled something much bigger, a coordinated effort by 50 nations to secure critical minerals. Not years from now, not gradually, but right now, and silver is at the center of it. The old silver market. To understand what's happening, you need to understand how silver used to work. For decades, silver prices were driven by hedge funds, banks, algorithmic traders, speculative momentum. These players didn't care about the metal itself. They cared about interest rates, currency moves, inflation expectations, technical patterns. Silver wasn't being priced as a strategic resource. It was being priced as a trading instrument, a volatile cousin of gold, a playground for leverage. And because of that, paper markets dominated. A small amount of real metal supported a massive tower of contracts. In some cases, hundreds of paper ounces existed for every single ounce of real silver. And the system worked, as long as nobody asked for delivery. The new buyers have arrived. But now, the buyers are changing, and that changes everything. The new buyers are not hedge funds. They are not day traders. They are not momentum chasers. They are governments, and governments don't behave like traders. They don't care about chart patterns, moving averages, short-term volatility. They care about national security, industrial survival, monetary independence, and most importantly, they have infinite time horizons. The first shift, silver is money again, across the United States, something unusual is happening. More than 24 states are moving toward legislation that allows their treasuries to hold physical precious metals. Not ETFs, not derivatives, not paper claims. Physical gold and silver. This is not just a symbolic move. It represents a quiet rebellion against the traditional system. Because for decades, state reserves were held almost entirely in U.S. Treasury bonds, cash equivalents, dollar-denominated assets. Now, states are beginning to ask a different question. What if those assets aren't enough? What if we need something tangible, something outside the banking system, something with no counterparty risk? And that question leads directly to silver. If multiple states begin allocating even a small percentage of their reserves into physical metals, that creates structural demand. Demand that doesn't care about price, demand that doesn't sell on dips, demand that just accumulates. And once that demand starts, it rarely stops. The second shift, silver as a strategic metal. Silver is not just money. It's a critical industrial resource. It asks in solar panels, electric vehicles, power grids, data centers, semiconductors, military electronics. Modern technology runs on conductivity, and silver is the most conductive metal on Earth. You cannot replace it easily, you cannot substitute it at scale, and you cannot build a modern electrified world without it. That's why governments are now classifying silver as a critical mineral. Not a luxury, not a speculative asset, but a strategic necessity. And when something becomes a strategic necessity, governments stop negotiating on price. They just buy. The third shift, the 50-nation purchasing cartel. This is where the story gets serious. The State Department's announcement wasn't just about cooperation, it was about coordination. A group of 50 nations forming a joint effort to secure mineral supplies. That means shared stockpiles, coordinated purchases, strategic reserves, long-term accumulation. And once metal goes into a government reserve, it doesn't come back to the market. Not next month, not next year, maybe not for decades. This isn't speculative demand, this is permanent demand. And permanent demand does something very dangerous to a market with limited supply. It drains it. The supply side reality. Silver supply isn't flexible. It's not like oil. You can't just turn on a new well and flood the market. Most silver isn't even mined directly. It has a byproduct of copper mining, zinc mining, lead mining, which means silver production depends on the economics of entirely different metals. You can't just open a silver mine because prices are high. That creates a dangerous setup, rising demand, rigid supply. And now, government buyers who never sell. This is the foundation of a regime change. Why paper markets may lose control. The paper-silver market only works under one condition, that enough physical metal exists to settle contracts if needed. But what happens when governments start absorbing massive quantities of silver and locking it away in strategic reserves? The pool of available metal shrinks. but the number of paper contracts stays the same, or even grows. Eventually, you reach a tipping point where the promises exceed the metal available to fulfill them. And when that happens, the paper price stops mattering because the real market moves somewhere else. This is how markets decouple. And once they decouple, prices don't rise gradually. They gap. A market mispriced for a new reality. Look at the current price action. Silver touched the low $90 range and then closed in the high 80s. Most traders saw that as just another volatile day, another swing, another chart move. But under the surface, the structure of the market may have already changed, because if governments are now the primary buyers, then the old pricing model is broken, and a market that is priced for speculation, but driven by strategic accumulation, doesn't correct slowly, it reprices violently. So what happens next? What happens when governments, not speculators, become the dominant force in the silver market? The first effect is already starting to appear, and it's not on the charts, it's in the physical market. The beginning of physical scarcity. When price-sensitive buyers dominate a market, supply flows freely. If prices rise too much, they step back. If prices fall, they step in. The system balances itself. But government buyers don't behave like that. They don't wait for dips. They don't try to time the market. They don't sell when prices rise. They just accumulate, and they keep accumulating. That kind of demand doesn't just move prices. It removes supply. Every ounce that goes into a strategic reserve is an ounce that never returns to the open market. Every shipment into a government vault is metal that won to be available to investors, manufacturers, traders, or exchanges. And when that happens, shortages begin quietly, not with headlines, not with panic, but with small signals. Dealer premiums start rising, delivery times stretch out, inventories shrink, product selection narrows, then comes rationing, then come delays, and eventually, the market reaches a point where price is no longer the main question. Availability is. When paper and physical collide for decades, the silver market ran on a delicate balance. Paper contracts set the price. Physical metal followed. But now that relationship is under pressure. Because paper markets can only function if physical metal is available when needed. If governments begin absorbing large portions of global supply, the metal needed to settle contracts simply won't exist. And that creates a dangerous scenario. A futures market priced on assumptions. Trying to settle obligations in a world where the metal is disappearing into national reserves. At that point, the system faces a choice. Either prices must rise dramatically to ration demand, or contracts must be settled in cash instead of metal. And if that second option happens, confidence in the paper market could collapse overnight. Because once traders realize they can't actually get the metal, the contracts lose their meaning. And when confidence disappears, price becomes relevant. The real market moves elsewhere. The binary choice for investors. This is where the situation becomes very simple, almost uncomfortably simple. If governments are accumulating physical silver and locking it away, then investors face a binary choice. Either you own physical silver, the same asset governments are securing, or you own paper silver, a claim inside a system that depends on trust, liquidity, and delivery. And those two things are not the same. Not anymore. Paper silver depends on exchanges, brokers, clearinghouses, counterparties. Physical silver depends on only one thing, ownership. And in a world where governments are competing for real metal, that difference becomes critical. Why price may no longer matter. In the short term, most traders are focused on price. They watch. Where support levels, resistance levels, moving averages, momentum indicators. But those tools were designed for a market driven by speculation, not for a market driven by strategic stockpiling. When a government needs silver for defense systems, power infrastructure, industrial supply chains, it doesn't try to check the RSI. It doesn't wait for a pullback. It buys what it needs, at whatever price is available. And when multiple governments do that at the same time, price becomes a secondary factor. Availability becomes the primary one. That's when markets stop moving in smooth trends and start moving in sudden jumps. The mispriced market. Right now, silver is still being priced as if nothing has changed, as if the old system still controls the market, as if hedge funds and speculators are still the main drivers. But if the dominant buyers are now governments, then the market is mispriced, deeply mispriced, because governments don't flip positions. They don't take profits. They don't panic sell. They accumulate, and they hold. And when a market transitions from speculative demand to structural strategic demand, the price structure changes completely. Instead of fast rallies, followed by sharp corrections, You get long periods of quiet accumulation, followed by sudden explosive repricing events. Not because of hype, but because the available supply is simply gone. The real turning point, the comments about metal-backed policy, the state-level treasury shifts, the 50-nation mineral purchasing alliance. These are not isolated events, they are signals. Signals that governments are preparing for a different financial world. A world where hard assets matter again, strategic resources are hoarded, monetary systems shift, and physical metals regain importance. Silver sits at the intersection of all of that. Money, energy, technology, defense, which makes it one of the most strategically important metals on the planet. And now, for the first time in decades, governments are starting to treat it that way. The coming price gap. If this trend continues, the market doesn't adjust slowly, it snaps. Because once the physical shortage becomes obvious, and once paper markets can't source metal easily, price discovery changes. Instead of trading on futures exchanges, price begins to form where the metal actually moves. In physical markets, in government contracts, in long-term supply agreements. And when that happens, the price doesn't drift upward. It jumps. Not because of speculation, but because the old price was simply wrong. The final question. So the real question isn't, will silver go up tomorrow, or next week, or next month? The real question is, what happens to the price of a strategic metal when governments around the world start competing for it? History gives us a simple answer. It doesn't move gradually, it moves violently. Because strategic demand doesn't negotiate. It takes what it needs, and it pays whatever price is required. Final thought. For decades, the silver market was driven by traders. Now it may be driven by governments. And when that shift happens, everything changes. The charts change. The volatility changes. The price structure changes. And the role of silver itself changes. This may not just be another rally. It may be the beginning of an entirely new era for the silver market. And the only real question left is, will the price adjust slowly or all at once?